Welcome back to Talk Tickers. It is Tuesday, February 17, 2026. If you are listening to this, you're probably staring at your portfolio, or maybe just the financial headlines, looking for a signal in a market that feels incredibly noisy right now. We are the Professional Earnings Call Summarization Podcast, and today we are doing something a little different. We aren't looking at the flashy tech stocks. We aren't looking at the AI darlings or the crypto runners. We are looking at the invisible giant.
Invisible is definitely the right word, but giant might be an understatement. We are talking about the machinery that literally keeps the American housing market functioning. The company that everyone knows by name, but very few people actually understand how to read the balance sheet for.
We're talking about Fannie Mae, ticker FNMA. They dropped their Q4 and full year 2025 results pre-market on February 11th. I have to be honest with you right out of the gate. I looked at these numbers, then I looked at the stock price, and I looked at the news coverage, and I felt like I was taking crazy pills.
It is a common side effect of following this company. I mean, the disconnect between the fundamentals and the market reality is wider here than perhaps anywhere else in the S&P 500 if it were allowed to be in the S&P 500.
Exactly. So before we even get into the billions, and there are many, many billions to discuss, we have to set the stage here. The context is honestly wild. We are talking about an entity with a guaranteed book of business sitting at $4.1 trillion.
Yeah.
That is trillion with a capital T.
Yeah, and to put that in perspective for you listening, $4.1 trillion is roughly comparable to the GDP of Germany. It is effectively the backbone of the entire American housing market. If you have a 30-year fixed mortgage, there's a massive probability that it lives somewhere inside that $4.1 trillion number. Fannie Mae is the reason the 30-year fixed mortgage exists in the way that it does.
And yet, despite that scale, despite the massive numbers we were about to break down, the market reaction was, let's just call it a shrug. The stock closed up 4 cents on the day of the print.
4 cents.
4 cents. It finished at $8.31, a 0.48% move.
Which, in isolation, that looks like stability. A flat day is better than a red day, right? But you have to zoom out. That stability came after a pretty brutal sell-off. In the month leading up to this call, Fannie Mae stock was down nearly 28%.
28%.
Yeah. So the context here isn't just how did they do this quarter? It is, can this earnings report stop the bleeding?
That is the perfect way to frame it. It feels like a clash of titans.
Yeah.
On one side, you have this record-breaking financial fortress they're building. And on the other side, you have a market that seems to be losing faith in the stock price, or at least the liquidity of the stock. So the mission for this deep dive is to figure out, is this company broken? Or is the market broken? Because you don't usually see a fortress lose almost a third of its value in 30 days without a fire somewhere.
That is the central tension of this quarter. And the answer is, well, it's complicated. If I had to put a label on it right at the top, I would say this wasn't a growth quarter. This is a fortress quarter. Management isn't trying to dazzle you with new product lines or massive top-line growth. They are building capital, they are cutting costs aggressively, and they are waving a very specific yellow flag regarding credit risk.
Okay, fortress quarter. I like that. Let's unpack the actual numbers then. If you were just tuning in for the headlines, what did Fannie Mae actually deliver?
Okay, let's run through the P&L. For the fourth quarter of 2025, net income came in at $3.5 billion. And if you zoom out, look at the full year 2025, they brought in $14.4 billion in net income.
$14.4 billion in profit.
Yeah.
I mean, just pause on that for a second. That is a staggering amount of money. There are massive companies, household names that don't generate that kind of pure profit in a decade.
It is huge. It really is a cash-generating engine. And that profit feeds directly into the most important metric for this specific company, net worth. As of December 31st, 2025, Fannie Mae hit a record net worth of $109 billion.
$109 billion. That is the fortress you were talking about.
Precisely. That is the fortress. However, and this is a big however, we have to look at the trend line. While $14.4 billion is a lot of money, net income for the full year was actually down 15% compared to the prior year.
Wait, down 15%. If the net worth is up to a record, why is the income down? Is the business slowing down?
It's not that the business is slowing down per se. In fact, revenue was flat. The drop in income came from two main drivers. First, they had to shift towards higher provisions for credit losses, basically setting aside more money for loans that might go bad. And we will get into that later because it is critical. Second, they just had lower fair value gains compared to 2024.
Okay, what does that mean in simple terms?
In the previous year, they had some accounting tailwinds, interest rate hedges that paid off nicely. That didn't repeat in 2025. It was just a tougher comp.
Got it. So the core engine is running, but they are keeping more cash in the rainy day jar, and the, let's call it casino luck with interest rates wasn't as good as last year, and revenue.
Yet revenues were effectively flat. For Q4, they brought in $7.33 billion. That is almost identical to Q3 and Q4 of the previous year. It is a very steady ship, but it is not growing the top line.
Okay, so we have flat revenue, slightly lower income, but record net worth. How did management spin this? What was the vibe on the call? Were they popping champagne over the $109 billion?
Definitely not popping champagne. No, I call the vibe neutral to cautiously optimistic. They were very proud of the streak. They emphasized that this is the 14th consecutive year of annual profitability. So they are trying to signal durability. You know, we are here, we are stable, we aren't going anywhere.
Stability's good, but usually investors want growth.
Right. And that's attention. The optimism they showed was purely about that capital accumulation, that $109 billion buffer. But the caution, and it was palpable, is all about the credit side, specifically looking ahead to 2026. They definitely were not telling a boom story for next year.
And that is where things get really interesting. Let's dive into our first deep dive segment, the capital fortress and the profit engine. You mentioned $109 billion in net worth. How are they actually making this money? It's not like they're selling iPhones. They aren't launching a streaming service.
No, they are a compounding machine, and it is primarily driven by net interest income, or NII. In Q4, 81% of their net revenues came from NII. This is the spread between what they earn on their assets and what they pay on their debt. Simple as that.
And a big chunk of that comes from guarantee fees, or G fees, right? I hear this term thrown around constantly. Explain it to me like I'm 5 years old. I buy a house.
Yeah.
I pay my mortgage to, I don't know, Wells Fargo. Where does Fannie Mae get a cut?
Okay, imagine a toll road. The bank Wells Fargo, in your example, is the car driving onto the highway. They want to sell that loan to investors so they can get their cash back and lend it to the next person. But investors, they won't buy the loan unless they know it's safe.
Because if I stop paying, the investor loses their money.
Exactly. So Fannie Mae stands at the toll booth, they stamp the loan and say, we guarantee this. If the homeowner defaults, Fannie Mae pays the investor the principal and interest. For that stamp of approval, they charge a toll. That's the G fee.
And that toll is recurring.
Every single month. As long as that loan is active, Fannie takes a tiny slice of the interest payment. Right now, on the single-family side, that toll, the average charge fee, is sitting at 48.7 basis points.
Just under 0.5%.
Right. But for multifamily, think apartment buildings, it is significantly higher. That fee is at 71.6 basis points. The beauty of this model is that as long as the loans perform, that fee income just rolls in every single month like clockwork. It's a massive annuity.
It sounds like the perfect business model. You sit there, you stamp the paper, you collect the toll.
It's great until the loans start performing. Then you are on the hook for potentially billions. That is the risk. But right now, the river of cash is flowing.
And they are actively managing where that money goes. I noticed a specific note about their portfolio strategy. They aren't just sitting on cash, they are reinvesting it. What are they doing there?
Yeah, this is a subtle but important shift in their treasury operations. They are moving assets from their corporate liquidity portfolio, which is basically just cash and cash equivalents, extremely safe but very low yield, into their retained mortgage portfolio. That portfolio ended the year at $132.5 billion, and they're specifically buying agency MBS mortgage-backed securities.
Wait, so they are buying their own product? Or their competitor's product?
Or Freddie Mac's product, yes. They're buying agency MBS because the yields are higher than just holding cash or treasuries. It's a yield-chasing move, but a very safe one because the government guarantees those securities anyway. They're trying to squeeze every single drop of return out of that balance sheet.
Let's play devil's advocate for a second. Why do they need $109 billion? I mean, why keep piling up this cash? It's not like they can pay a dividend to shareholders, given the conservatorship status.
Sure.
Why not just lower the fees and help home buyers?
That is the $109 billion question. And it all comes down to one thing. Regulatory capital requirements. Under the current framework set by the FHFA, the regulator, they are required to hold a massive amount of capital, essentially a fortress level of capital, to ensure they never ever need a taxpayer bailout again like in 2008.
So they're basically filling up a swimming pool with a teaspoon.
Exactly. And the pool is massive. They are nowhere near the final requirement yet, even with $109 billion. So every single dollar of profit is trapped. It must be retained. They're creating this massive buffer against economic shock.
But the market isn't rewarding the stock price for it right now.
No, because shareholders can't touch it. It's trapped capital. But from a credit perspective, from a bondholder perspective, or if you were just worried about the stability of the housing market, Fannie Mae has never been stronger.
Okay, so the top line is flat, but the bank account is growing. Now, usually when a company has flat revenue, they start looking at the expense side of the ledger to keep margins up. And boy, did Fannie Mae do that in 2025. This leads us to segment 2, the efficiency narrative.
This was one of the most striking disclosures in the entire call, I thought. We often think of Fannie Mae as this quasi-governmental, slow-moving giant. You picture endless meetings and, bureaucracy. But they took a machete to their workforce this year.
They specifically disclosed a reduction of approximately 1,200 employees in 2025.
That is a significant number. That is a small town worth of people.
Yeah.
And it wasn't just full-time employees. They scaled back contractors significantly. They renegotiated key vendor contracts. They even reduced their real estate footprint, closing offices, shrinking floor plans.
It sounds like a tech company post-COVID. Operational efficiency was the buzzword.
It really was. Acting CEO Peter Aquabua and CFO Krissa Haley hammered this point home. They called it operational excellence and simplifying tech infrastructure. And the numbers back it up. Their administrative expense ratio improved to 12.36%.
So for every dollar of business they do, they are spending about 12 cents on admin. That seems pretty lean for a company of this size and complexity.
It is becoming leaner, and this is the crucial context for you to understand. The host mentioned earlier that revenue was flat at $7.3 billion. When you have zero growth in revenue, the only way to maintain or grow profitability, the only way to keep filling that swimming pool is to cut costs. This is a pure margin protection play.
It is also a signal about how they view the future, isn't it? If they thought a massive boom in mortgage origination was coming, they would be hiring. They would be staffing up to handle volume. Cutting 1,200 jobs tells me they're digging in for a grind.
Exactly. It signals they expect a static or difficult environment. You don't cut capacity if you expect a flood of new business. You cut capacity when you want to become a fortress impervious to the weather outside. You batten down the hatches.
Speaking of the weather outside, let's look at the storm clouds. This is the most critical part of the episode.
Yeah.
If you are multitasking, come back to us for a second. We need to talk about credit risk. Segment 3, the credit divergence.
This is the tale of two cities. It really is. On one hand, you have the single-family business. On the other, the multifamily business. And they're moving in opposite directions.
Let's start with the good news. Single family, your standard home mortgage.
The rock. Single-family serious delinquency, or SDQ, is sitting at 0.58%.
That is incredibly low historically, right?
It is. It's pristine. Now, it did rise slightly, about 4 basis points quarter over quarter, but management was very quick to brush that off. They attributed it to seasonality. People tend to miss payments around the holidays, and specifically forbearance from the government shutdown.
Right. There were some federal pay disruptions that rippled through, so nothing systemic.
Not in single family. The credit profile of the American homeowner remains pristine. High FICO scores, strong loan-to-value ratios. If you own a home in America right now, you are statistically very likely to be paying your mortgage. The American homeowner is resilient.
Okay, that's the rock. Now let's talk about the crack in the foundation. Multifamily. Apartment buildings. This is where I got a little nervous reading the transcript.
This is where the tone of the call shifted. You could feel it. Multifamily serious delinquency rose to 0.74%. That is up significantly from where it was a year ago.
And it wasn't just the current number, right? It was the warning about the future.
That's the key. Management explicitly stated, and I'm quoting here, multifamily delinquency levels could increase in 2026. They didn't say might stabilize. They didn't say could level off. They said could increase.
What is driving that? Rents are still high in most places, aren't they? Every time I talk to someone renting, they tell me it's too expensive. How are landlords losing money?
It's a math problem. Rents are high, yes, but rent growth has stalled. It's flatlining. Meanwhile, expenses for landlords, insurance, taxes, maintenance, labor are skyrocketing. And crucially, a lot of these landlords bought properties using floating rate debt or short-term financing when rates were near zero.
So their mortgage payment doubled, their insurance tripled, but their rental income stayed flat.
Exactly. That squeezes the landlord's margin. It crushes it. Net operating income, or NOI, stagnates or falls. If they are highly leveraged, they start to miss debt payments. And Fannie Mae holds $535 billion of this paper.
$535 billion. That is a massive exposure.
It is. Now, here is where it gets really weird. And this is the part that I think requires the most scrutiny for any investor. We have rising delinquencies, a management warning about 2026, so you would expect them to increase their allowance for credit losses, right? Put more money in the jar for a rainy day.
That would be the logical move if the storm is coming, you buy sandbags.
They did the opposite. They actually reduced the multifamily allowance by $93 million this quarter.
Wait, hold on. Risk is going up, delinquencies are rising, management says it's going to get worse, and they took $93 million out of the safety jar. How do they justify that? That sounds dangerous.
It relies on a very specific, and I would argue a very optimistic accounting argument. They argued that stabilized property values on the existing book meant they didn't need as much reserve for the old loans. Basically, even if the landlord defaults, Fannie believes the building itself is worth enough to cover the loan.
So they were betting on the collateral. They are saying, sure, the borrower is broke, but the building is still worth $10 million, so we are fine.
Correct. That's the bet. And they also argued that the specific charge-offs they took this quarter exceeded the allowance needed for new acquisitions they made. But you nailed it. It is a bet on property values holding up.
But isn't commercial real estate currently in a correction? Especially office, but multifamily is seeing it too.
Parts of it are, absolutely. If we see a broader correction in multifamily property values in 2026, that decision to release $93 million in reserves is going to look very optimistic in hindsight. It feels aggressive.
So to recap this part, single family is the rock, multifamily is the hard place. And they are betting that property values hold up enough to navigate the storm, even as they warn us the storm is getting worse.
That is the bet. And remember, they have that $109 billion net worth as a backstop, so they can afford to be wrong. But for a listener trying to read the tea leaves on the real estate market, Fannie Mae just told you. The stress is in the apartment sector, and it is not over yet.
Let's move on. Segment 4, market share and competitive dynamics. Because Fannie isn't the only game in town, management admitted they are losing some ground here.
They did. They were very upfront about it. They admitted that competitive dynamics compress their share of new business.
Is it just private lenders being more aggressive? Or is it something structural?
It is structural. It goes back to what we talked about earlier. Fannie Mae has these strict capital requirements. They have to hold a certain amount of capital for every loan they buy. That raises the cost of doing business. If a private competitor, or even a different type of entity like an insurance company or a private credit fund, doesn't have those same handcuffs, they can offer a lower rate or better terms.
So Fannie is the responsible adult at the party who has to go home at 10 p.m., while the private capital guys are staying out until 4 a.m.
That is a great analogy. And because Fannie cannot race to the bottom on pricing, they lose the deal. Management said this share loss could persist in 2026. They aren't expecting to suddenly win back market share unless the rules change.
What about refis? We saw rates dip a little bit in late Q3 of 25. Did that help?
It helped a little. There was a $19 billion increase in refinance acquisition volumes in Q4. It was a nice little refi pop.
We'll say.
But overall, when you look at the size of their book, it is tough to replace the loan runoff. Loans are being paid off or amortizing down faster than they can find new profitable loans to replace them.
And there was a technical note about CRT credit risk transfer. This is how they sell off some of the risk to private investors, right?
Right. CRT is supposed to lower their capital requirements. The idea is, hey, we sold the risk to a hedge fund, so we don't need to hold as much cash against that loan. But the problem is a lot of their old beneficial CRT deals are running off, they're expiring. And the new deals they're trying to structure aren't giving them as much capital relief. So their risk-weighted assets, or RWA, actually increased. It's a headwind. They are running faster just to stay in the same place regarding capital ratios.
So putting it all together for the deep dive, we have a capital fortress that is growing wealth but losing market share, cutting costs to protect margins, and watching a storm brew in the multifamily sector.
That is the summary. It is a defensive crouch. A very profitable defensive crouch, but a crouch nonetheless.
Which brings us to the investor context, the elephant in the room. Why is this stock trading at $8? If you have a company earning $14.4 billion a year with $109 billion in net worth, in a normal world, that is a triple-digit stock price, easily.
In a normal world, yes. But Fannie Mae does not live in a normal world. It lives in conservatorship.
The dreaded C word.
The government owns the warrants for 79.9% of the company. The government controls the profits through the net worth sweep agreement. Shareholders have been in limbo since 2008. The reason the stock is down 28% in the last month and 10% in the last quarter, while the broader financial sector, XLF, is flat or down slightly, is macro. It is not about the earnings.
So the earnings beat or miss doesn't really move the needle.
Clearly not. They delivered $3.5 billion in profit, and the stock moved 4 cents. The market is telling you, loud and clear, we don't care how much money you make until we know if the shareholders ever get to see it.
It's the ultimate value trap argument.
It is the textbook definition. You look at the balance sheet and say this is historically cheap. You look at the legal structure and say this is uninvestable. And the recent sell-off suggests that liquidity is drying up. Big players might be exiting because they don't see a resolution on the horizon.
And looking at the 2026 outlook, management didn't give us a catalyst. They didn't point to some light at the end of the tunnel.
No. They signaled a grind. Competitive pressures persisting. Multifamily delinquencies rising. There was no boom narrative here. The only catalyst they offered was, we will keep retaining earnings. If you are a shareholder waiting for a payout, that requires an almost infinite amount of patience.
So the stock price is disconnected from the fundamentals because the fundamentals are locked inside a government vault.
Perfectly stated.
All right. We have covered the fortress, the cuts, the cracks, and the trap. Now, it is time to shake things up.
My favorite part of the show.
It is time for our This Is Not Financial Advice segment. Please remember, we are just two voices on a podcast.
Okay.
We are not your financial advisors. Do your own due diligence. Do not trade based on what we say. We are just having fun with the data.
Strictly for entertainment purposes.
Okay, expert. You have analyzed the call. You see the data. You see the divergence. Give me the wild trade. If you're pitching this to an investment committee at a high-risk hedge fund, let's say you want to get fired or get rich, what is the play?
Okay, I have one. I call this trade the landlord's hedge.
The landlord's hedge. Talk to me.
This is a long-short pair trade. It's designed to capitalize on the specific divergence we just talked about. Here is the setup. You go long Fannie Mae, FNMA, and at the same time, you go short a basket of pure-play multifamily REITs.
Whoa. Okay. Walk me through the logic here. Why long Fannie? We just spent 10 minutes talking about why the stock is a value trap.
You buy Fannie Mae because, despite the stock price lethargy, it is the ultimate safety play in this scenario. It has $109 billion in net worth. It is aggressively cutting costs, 1,200 jobs gone to protect its margins no matter what. It is priced for absolute disaster, treating at a tiny fraction of its book value. It is the fortress. If the world gets scary, if credit markets seize up, Fannie Mae is where the money sits. It's a call option on survival.
Okay, so Fannie is the shield. It's the too big to fail part of the trade. Why short the REITs?
Because Fannie Mae, the biggest landlord proxy in the entire world with that $535 billion book, just explicitly told you what is happening on the ground. They told you rent growth is softening. They told you NOI is pressured. Most importantly, they told you delinquencies are rising in 2026.
So you are using Fannie's inside information, essentially, against the sector itself.
Exactly. You're fading the landlords. The REITs are the ones who have to deal with the property level pressure. They are the ones who have to deal with the vacancies, the rising insurance, and the maintenance costs. Fannie sits a layer above that. Fannie gets paid the G fee unless the loan completely blows up and goes to foreclosure. The REIT takes the hit to cash flow immediately when a tenant doesn't pay or expenses rise.
That is actually kind of brilliant. It's cynical, but brilliant.
It's the outrageous angle. You are betting on the government-backed giant to survive the storm, while betting against the very assets they insure. You're effectively profiting from the softness that Fannie Mae management just warned us all about. You hide behind their $109 billion balance sheet while the landlords get squeezed.
The landlord's hedge.
Yeah.
I like it. Again, not financial advice, but definitely something to think about as you look at those apartment complex stocks. It's a way to play the data without fighting the government.
It's a data-driven speculation based directly on the transcript of the call.
All right, let's bring it home. Recap time. Fannie Mae Q4 and full year 2025. What's the bumper sticker?
The bumper sticker is, the fortress is strong, but the moat is getting muddy.
I like that. They delivered $3.5 billion in Q4. They hit that record $109 billion net worth.
But the costs of maintaining that are high. I mean, 1,200 employees lost their jobs, and the credit risks in multifamily are creeping up undeniably.
And the market just shrugged, up 4 cents. It is waiting for a catalyst that isn't just more retained earnings. It wants structural change, or wants to see the other side of this credit cycle.
Until then, it's a savings account that you can't withdraw from.
Well, on that cheerful note, that wraps up our deep dive into Fannie Mae. If you want to know if that $109 billion net worth is real, or if you think the multifamily cracks are going to spread into a full-blown earthquake, let us know.
We want to hear your take. Are you trusting the fortress, or are you watching the cracks?
Subscribe to Talk Tickers for the next earnings breakdown. We will be here sifting through the numbers so you don't have to. Until next time.
Stay curious.